And game plan for today is to make significant inroads into chapter 3. I want to, okay, guys, 1 second, because Zoom is giving me a hard time today. It doesn't seem to want to let me log in on more than one device, which is a little silly. It's not really considering the needs of the presenter when it's putting that policy in. Okay, so it's not going to allow me to do what I need to do. This is something I'm going to have to talk to some of our administrative folks about. Can you hear me right now?
Yes, we can.
Yeah.
Yeah, we can.
Okay. Okay, so it looks like guys, I'm gonna have to leave the meeting and come back. I'll be back, okay? Sorry about that.
Okay.
Okay, you can hear me now?
Yeah, we can.
No? Okay. I'm going to be a little hamstrung today on being able to see everybody because they won't let me log in on a second computer, which I don't understand why that would be something that they would want to constrain. So I'm going to try to get some help on that at another time. So I'm going to assume that you can see my screen right now, since I can't monitor that.
Yes, we can.
Yes.
Okay, great. Thank you. Okay, so what we're going to do is we are going to go ahead and take a look at the chapter 3 slides and the chapter 3 practice midterm. I think that's a pretty, good chunk of material for us. So I think that's about as far as we'll get today. On Thursday, we will go through one of the practice midterms, and again, I'm a little hamstrung. I'm hoping that you're seeing what I'm putting up here, which is going to be, you ever notice companies, they can't leave things alone. They can never leave something alone that's working. They always have to do something that causes it to not be as effective of a product to use. I think they sit around in boardrooms and decide, how can we make our product less useful to our customer? But anyway, let me stop there. So I'm assuming right now you can see my Canvas screen.
Yeah.
Yes, we can.
Okay.
Yes.
Okay, so if you notice, I did put up some practice midterms. Next time, we're going to go through at least this one and maybe, let me see. Yeah, maybe this one, if we have time next time. Okay, so again, we will go through at least that, what is labeled there as practice midterm, second practice midterm one. Okay, that one, we'll definitely go through that one next time. As you recall, the exam will open just after class, and it'll stay open until, somebody remind me of what we've said now, until
Monday, the 13th at 11:59 p.m.
Oh, yeah.
Monday, the 13th at 11:59 p.m. That what we said? Okay. Monday, 7/13/2023 at 11:59 p.m. I know I have that written elsewhere. Okay. Okay, so that's the game plan for the next couple classes. Any question? Okay, good. So let's go ahead then, and I'm going to jump us into these chapter 3 slides, and hopefully we'll get through this practice midterm 3 today. Okay, so let me begin by asking a couple questions. Okay, now let's say a company has provided a service, they have earned the revenue. Say the revenue was $10,000. What account should be credited?
Cash.
Free earned,
I'm sorry?
free earned,
Are we saying fee earned? Is that what I'm hearing?
yes,
So we're saying revenue, right? Oh, really? Is it gonna be one of these days? Oh. 1 second, guys. Got a ton of technical fun here today. 1 second. This is getting ponderous. Okay. Okay, I'll try it again. Okay, you can see my screen? Hello?
yes,
Yes, we can.
yes,
Okay, good. So I asked what account should be credited. And the answer is what? That I should credit revenue for $10,000? Right? Okay.
Yes.
I know there has to be a debit because debits equal credits. So what are my options on what could be debited?
cash,
Cash.
Okay, maybe cash. Maybe cash, because if somebody paid me in cash for that service, then I could debit cash. Okay, good. Anything else?
Accounts receivable.
Okay, I could debit accounts receivable because maybe the person has said that they're going to pay me later. Okay, good. Now, there could be some other, things that might happen. For example, let's say I owed somebody some money and I provided them service to work off that debt that I owed them. Say I had an account payable for 10,000 and I did some work for them, and then they went ahead and forgave that debt or canceled that debt as a result of that work I did. It's possible, not very likely in our class, I wouldn't ask you a question like that. But in the accounting world, in the business world, it's possible that I could cancel a debt and have a debit to account payable, right? Okay. But the main ones that I think we're interested in are these two. And the main takeaway from this discussion is what? The recognition of revenue does not necessitate receiving cash. It necessitates what? Having provided the service. Right,
Yes.
guys?
Yeah.
Okay, good. Now I have to comment, and I'm sorry, because there was an option provided that when I have provided the service, there would be a credit to cash. When do we credit cash?
When it's being taken away.
Yeah, when we were trying to decrease our cash account. So I'm not sure why we threw out the option of crediting cash, because why would our cash account go down when we provide a service? That would be that'd be a very strange transaction. In fact, that's impossible. Okay. All right, good. Now, let's say that I have incurred an expense. Okay. And so my expenses need to go up. What should I debit?
Expense.
Okay, when my expenses go up, I should debit expense. Guys, we're running out of time for this stuff to still be, squishy for you. I mean, this needs to be snap like this when I ask you that, okay? So if I had expense, say of $7,000, okay, that means that what? The future economic benefit associated with whatever that activity was has expired, right? So what should I credit? What are
Cash.
some options, huh?
Cash.
Okay, if I paid cash for that expense, good. Then I can go ahead and credit cash. What else?
Account payable.
Good. Accounts pay a bill. Okay, good. If I had not paid yet, but I was going to pay in the future, I'd have a bill. I still recognize the expense though, because the future economic benefit has expired. Good. Anything else? I could credit what? Some sort of prepaid expense, right? The word prepaid implies to you that it is an asset, implies to you that it is an asset. And so as the future economic benefit expires, I could debit the expense, credit the prepaid, right? Okay, good. Any other possibility? The one other possibility that I can think of here, well beyond the scope of this class, is let's say, at least beyond the scope of 1A, you'll probably see it in later classes, but it could be that I go ahead and I issue stock in exchange for a service that provides me. Somebody provides me, so they provide me, say, some legal services. I'm just starting up my company. I say, look, I don't have a lot of cash in the company. Would you be willing to take back stock in exchange for this service? Well, then I would credit my common stock and debit the expense for that service that they provided me. But I'm not going to write that down because that's beyond the scope. In our class, these are the ones that we will pretty much be dealing with here, right? Okay. Question. Now, one of the things that I like about accounting is that if you figure out one side of the journal entry, the debit, the credit, you can often then think your way through, well, what are the options for the remaining choices of what the to complete that journal entry, to look for that debit, that credit, whatever it is, right? Okay, good. Now, what I like, okay, what I like about accounting is that part, but what we've been talking about here is something called accrual accounting. And what accrual accounting says is cash is not what triggers the recognition of an event. If we're talking about a transaction event, if we're talking about revenue, then it's the what? We have completed, provided the service. That's what causes us to recognize revenue, not the receipt of cash. If we were talking about an expense, what causes us to recognize the expense? It is not the payment of cash, but it is what? The expiration of the future economic benefit. Okay, so we come over and we start to take a look now at some things that really we've already understood from our discussion of the year one, year two example that we went through with our DJ Pizzazz company, et cetera, right? Remember that? Okay, and so you take a look, and when we talk about prepaid expense, that means we have paid the cash, but we're not going to recognize the expense until the future economic benefit expires. So in this example, I'm saying, okay, we've got a nice apartment somewhere in Cupertino, nice area in Cupertino there. And I tell you that the apartment is a 5,000 square foot penthouse apartment, top floor, nice view up in the hills somewhere, I guess, whatever. It's brand new. Nobody else has ever lived there. It's got, you know, tip top of everything. In fact, I go ahead and I let you take a look at the place and you almost pass out. The place is so nice, right? So I say to you, okay, I'll tell you what, I'll rent this to you for $1,200 for the entire year. All you got to do is you've got to pay me the cash in advance. Anybody interested? And, you know, the whole room erupts. Yeah, I'm interested, right? Because in the Bay Area, that'd be a pretty good deal. $1,200 for a 5,000 square foot beautiful apartment in the hills. Heck, $1,200 would be a deposit on a dump of an apartment in the Bay Area, right? So you said, yeah, okay, yeah, I'll do that, okay? So what happens? When you hand me the cash, you're going to credit what? Credit cash for $1,200. You see that credit there. I'm just writing that journal entry in there. Okay. That's when you pay me on, say, January 1st. I'll put the date in there. January 1st, you pay me. 1/1, you pay me. You don't want a debit expense because what? You've got 12 months of future economic benefit coming as you're going to live there over the year. So you go ahead and instead you debit the asset prepaid rent, because you in fact have paid that in advance for the full year. You have an asset there, so you debit that asset prepaid rent. Okay, now what happens at 1/31? Has any future economic benefit expired? The end of the first month.
Yes,
Really, yeah, I'm really going to need you to respond to that because I can't see you. So 1/31, has any future economic benefit expired?
Yeah.
Yeah, we have that 1 month expire. So 1,200 divided by 12 months is $100 per month. So at 1/31, I go ahead, I debit rent expense, I credit the prepaid. Now, if we were to tee up the prepaid rent immediately after we post that credit to the prepaid rent, we posted the debit there, right? First, we posted the debit. Then we go ahead and we post, right? First, we record the entry in the journal, then we post it to the ledger, and we see that there's what, $1,100 left in that prepaid rent account. When we were to prepare a financial report at 131, the world would know, they may not know all the details, but that we've got what, 11 months left at $100 a month on this, right? Question. Now, if that's the entry for the tenant, the entry for the, I don't know if they still call it the landlord, whatever, the owner of the property would be what? When we receive that cash, okay, let's say you're paying me cash, of course, I have to debit cash. To increase cash, you debit it. I can't take the revenue yet because we recognize revenue in a situation like this as time passes, right? I earn the rent each month that you live there. So I can't credit revenue yet. So I credit this account unearned revenue for $1,200. What kind of account is unearned revenue?
Is that credit?
Well, obviously I'm crediting it, debit to the left, credit to the right. What kind of account is it?
It's like
Liability.
Liabilities.
Liability, right? If somehow I, decided, hey, I don't want to rent this to you, and I was able to get you out of there somehow, I would have to give you back any rent that you hadn't used up, right? So anytime there's a chance that you'd have to get some money back, then you have to credit a liability, right? Okay, good. Then what? After 1 month, have I earned any of that revenue? After 1 month, have I earned any of that revenue? I've earned what?
$100.
$100.
$100 1 month. So I debit the unearned and I credit the revenue. Now, if I had, I'm just going to write it up here since I see something was set up there already. If I had an unearned revenue ledger account, okay, when I credited it for 12, the balance would have been 12. All right, that's that credit right there when I post that. And then when I post that debit right there, now the balance is 1,100. And so at 12/31, the world would be able to see, hey, he's got, 12, well, now at that point, 11 more months left where he's going to be earning revenue. Question. Okay, good. Let's go ahead then and let's take a look at how that looks in our ledger accounts. And I don't know, I contemplate getting rid of this slide, but whatever. So what happens? We debit the prepaid, right? Credit cash. We're not teeing up cash here. And then we go ahead and as we earn, we do what? We debit, as not earned, but as the future economic benefit expires, we debit the expense and we credit the asset.
Yes.
Okay. Okay, good. Let's go ahead then and let's take a look at the example supplies. And we had this in the year 1, year 2 example as well. But this company goes ahead and 1 second, guys, I need to move something. Zoom is driving me nuts today. Okay, so I go ahead and I purchase some supplies. Okay, now when I purchase supplies here on October 5th, I would go ahead and I would debit supplies. You see that right there, debit supplies. And I'm going to, and from the way this question, this description of this slide was written, you wouldn't know that it was on credit. I just assumed that we purchased this on credit, meaning that I'm going to have an account payable. Okay, so I go ahead and I debit supplies and I credit my account payable for $2,500. Now, when I do, the balance in the supply account comes up to $2,500. Okay, and that's why the sort of where this problem started, the account shows a balance of $2,500 on October 31st. Okay, but then I go and I actually count the inventory and I reveals that there's only $1,000 worth of the supplies left. So my account is showing what? 2,500, but it really should only show 1,000, right? Because that's all that's left. How do you turn an asset account that's showing a balance of 25? How do you make it show 1,000?
You credit it.
Good. You credit it because you want to decrease that asset. Beautiful. Perfect answer. And we know that we have to credit it by what? $1,500, right? 25 minus 15 would give me the 1,000. So at October 31st, the adjusting entry would be to do what? To credit the supplies. That brings it down to 1,000. And since the supplies aren't there anymore, I guess the future economic benefit has expired. I don't know if I used them or they got stolen or what. I just know they're not there for me to use anymore. And so I would go ahead and debit supply expense. Good. Question. Okay. All right. Excellent. Let's look at another example of a expense paid in advance here, which is insurance. Okay. So what happens? It tells me that on October 4th, we paid $600 for a 1-year fire insurance policy. Coverage began on October 1st. Okay, so I go ahead and I debit my prepaid insurance for $600 and I credit my cash for $600. When I post that prepaid, now my prepaid insurance is showing $600. I've got what? 1 year of insurance coverage, 1 year of future economic benefit. Now, sometimes students say, well, how is having insurance future economic benefit? Well, look, the law is in the state of California, for example, well, it's not for fire insurance. For fire insurance, it might be that I have a mortgage on some property or something, or I'm renting the property and the owners say, hey, you have to carry insurance, okay? So the future economic benefit when you get insurance is that you're able to operate within the, if it was automobile insurance, within the context of a law or with the context of a contract that I'm renting. A mortgage note is like a contract. They'll say, hey, you need to carry insurance or we're going to call the debt, et cetera, right? So it's allowing me to operate within the parameters of the law or within the parameters of some contract or something. Okay, so that's the $600 of future economic benefit that I have. And then they tell me this account shows a balance of $600 at October 31st. What is the adjusting entry that I have to make to update this account at October 31st? Because right now, before I write in this other stuff, it's showing me $600. So $600 divided by the 12 months in the year means that what? $50 is going to expire every month for the next 12 months. So at October 31st, I would debit insurance expense. I would credit the prepaid. When I credit the prepaid, now the prepaid shows that I have $550 left. That's 11 months at what? $50 a pop?
Yes.
With so far. Okay. Now, this other stuff that I wrote in here, because you will see some questions when we look at the practice midterm here for chapter 3, where I'll say the company did not make an entry in October, November, December, but at December 31st, they want to catch up and they want to make the adjusting entry. Well, if I wait until December 31st before I record any insurance expense, now I have to record the insurance for what? Expense for what? For all of October, all of November, all of December, 3 months. So now I take that $50 per month, I multiply it by 3, and I would debit insurance expense $150 and credit the prepaid $150 to catch myself up by the end of the year. Often accounting problems will talk about that because sometimes companies don't adjust their books on a monthly basis. They're only going to prepare year-end statements. And so sometimes you'll have to do some activity to help you to, catch up by the time you're going to issue your end statements. Question? Okay, good. Let's go ahead and take a look at unearned revenue. And as we've already been reviewing, Unearned revenue comes up when you receive the cash, but you haven't provided the service yet, right? Okay, and because we haven't provided the service yet, that unearned revenue is a liability, okay, because we haven't performed the service. So we go ahead, and in this example, I'm saying, well, somebody gives me $120,000 of cash prior to me providing the service. So I debit the cash and I credit the unearned revenue, 120,000. Now, let's say they give me that money and then they give me the money July 1st, let's say, and then I don't do anything. I'm going to do work for them each month, and I don't do anything in July. I don't make any journal entry in July, but I provide the service. I don't make a journal entry in August, September, October, November, December. I come to December 31st, I say, uh-oh, I need to catch up my financial reports now because I have provided 6 months worth of service. So 120,000, if it was a 12-month contract, 120,000 divided by 12 means I'm earning what? 10,000 a month. I've done the work for 6 months. 10,000 times 6 is 60,000. I would debit the unearned revenue and credit the revenue now because I've provided the service. So you will see some questions when we look at the practice midterm. It's not always 1 month I'm asking you to calculate. Sometimes I'll ask you to go ahead and figure out what needs to be done at the end of the year to catch up the financial statements for things that hadn't been recorded previously. Question.
And they always have to balance, right?
What always has to balance?
Like the liability and the revenue, they have to be 60,000 on each side. Because you're debiting and crediting on, you're debiting liability and crediting revenue.
Well, debits equal credits, but these two accounts do not necessarily have to be the same amount, I think. What if I had only provided 1 month of service? Let me answer the question that way. So it's 120,000. I divide that by what? By
12.
12 months. Thank you. 12 months. That's how much per month?
10,000.
10,000 per month. So if I was just recording it for 1 month, then see if it's not going to let me erase this, but then the journal entry would be a debit to unearned for 10,000 and a credit to revenue, right? Are we in agreement there?
Yeah.
Okay, and then the revenue would show what?
10,000.
You have to ignore this up here. The revenue would show 10,000. What would be showing when I post the debit? What would be showing in the liability? Come on, guys, that's the easiest question I asked you all day. What would be showing?
$110,000.
110,000. Good. Does that answer your question?
Yeah.
Okay.
Thank you.
Yeah, they matched in that case because I performed on half the contract, right? If I perform on less than half of the contract or more than half of the contract, then they won't match, right? Okay. Question. Okay, good. Now you come over and they tell us that this advertising agency received $1,200 for advertising expected to be completed by December 31st. Unearned revenue shows a balance of $1,200. Now, let's just look at October 1st. They would have debited cash for how much? 1,200. And credited unearned revenue for 1,200. Okay, debited cash, credit unearned revenue for 1,200, and then they say on October 31st, it looks like we had provided, we do an analysis to reveal that we had performed $400 of the service at that point in time. So this question was easier than some of the other examples we've been looking at. I didn't even have to do any math to figure it out. It just told me you had earned 400. So I go ahead, I debit the unearned, I credit the revenue for 400. Guys, at this point, you should start to understand or start to feel very, very confident. And that pretty much what we've looked at now is a repetition of these concepts that, it's not like I'm just washing you over with a whole bunch of new. We've spent quite a bit of time slowly going over these basic concepts of accrual accounting, right? And we've seen this now several times. So I'm thinking by Thursday at 11:30, whatever, when class gets out, you should be killing on the exam that I'm giving you. Okay. Okay, good. Accrued revenue. What's that? That means that we're going to take the revenue before we receive the cash because we've earned the revenue and we haven't been paid yet, right? Okay, so when you look at this one here, the person says, uh-oh, I better bill my customer. So I provided the service, I'm going to charge $200 for that. So I debit the accounts receivable. I credit the revenue, not because I've received the cash, but because I've provided the service. Then, of course, when the person pays me, right, then I can debit the cash and I can credit the account receivable. And we've talked about that several times. Question. Okay, accrued expenses. And here we take the expense before we have paid the cash. Okay, now let's look at this salary discussion. And when you think about a question where we're talking about salaries, I want you to think, even though they're asking for the accounting in terms of the company that's paying the salaries, I want you to think of it in terms of you as an employee working and receiving the salary, okay, and how you feel as you're going through, and they're talking about the situation here, okay? So they tell us that this company pays their salaries on Friday. So on Friday, okay, and this is October up here. On Friday, October what? 26th, they paid the salary. That's Friday. Okay. Now, apparently, for this company, they don't work on Saturday and they don't work on Sundays. Okay. They work on Monday, Tuesday, Wednesday, Thursday, and Friday. And Friday is the day that there's a payment, right? Okay. So while we're still in October, okay, we didn't work on the 27th. We didn't work on the 28th. What day is the 20 is Monday?
29.
29.
Okay, good. That's going to be the 29th. Then we have the 30th. We have the 31st. And then we're going to go what? Into November. And we're going to have November 1st and November 2nd here. And there's going to be another payday on the 2nd. With me so far?
Yeah.
Yes.
Yeah.
Now they tell us that our employees earn $400 per day. And so they don't earn anything on Saturdays and Sundays because they don't work those days. So we have what? 400 on Monday, 400 on Tuesday, 400 on Wednesday.
Yes.
And the question is asking you, well, if the company wanted to catch up their records for month end on October 31st, has any future economic benefit expired in October? And we're ignoring whatever would have been recorded since the last payday, okay? So in October, what we haven't made an entry for yet is what? Monday, Tuesday, Wednesday, the 3 days. So they go ahead and they debit salary expense for 1,200. They can't credit cash yet because they're not going to pay the people until what? Until
Friday.
Friday. Huh?
I was answering Friday.
I'm sorry?
No, never mind. It's
Okay.
fine.
Okay, they're not going to pay anybody until Friday, okay? And so what happens on the 31st, I would go ahead and I would credit salary payable 1,200, meaning that I owe what, $1,200 to my employees? What happens if the next day I close my business down? Do I still have to pay them the 1,200 for the work they did?
Yes.
Yeah, okay, if you don't believe that, if someone ever tells you, like, you can't pay you for the work you did, there's a department in the state of California called the Wage and Hour Division of the Department of Labor. They'll go ahead and they'll have a conversation with those folks and tell them they need to pay you. Okay, so we go ahead and we have what? We have this $1,200 salary payable. Okay, now what happens? Now the folks continue to work and they work Thursday, and they work Friday, the 2nd in November. Okay, and what would you do if your boss came to you in this situation on November 2nd and said, here you go, here's $800? What would you say to him?
Where's the rest?
Where's the rest? Wait a minute. I've worked 5 days this pay period. I want the full 2,000, right?
Mm-hmm.
So what happens? The boss says, oh, okay, I'm sorry. Let me go ahead and give you your 2,000. Okay, I see I got myself a smart employee. So I got to pay him the full 2,000. So I'm going to credit cash 2,000. I already set up a what? Payable for the 1,200, so I can debit salary payable. Now that is showing 0 because I've now paid up for those 3 days, right? And at that point, I haven't taken an expense yet for my first 2 days of November. So I will do what? Debit salary expense 800. That's the 400 times 2, right? For the 800, I debit my salary expense for that 800 because I haven't taken expense for that yet. I took expense for the 1,200, but I need to take an expense for that entire, for those last 2 days of November. And then presumably I'll do what? I'll continue to roll through November and continue to take expenses as my employees work for me in the balance of November, right? So I've got 800 now for November. Question.
Is there a way you could zoom out on the slide? It's a little hard to see.
Well, before I get into all that, because that could start to become, I could start to become a slide disc jockey. So is that a consistent problem? Because I can't see.
Yeah, the slide's been zoomed in for a bit.
Is that a consistent problem? Because I can't see. And I don't understand why the slide would have been zoomed in because I haven't done anything on my end. I need a second answer there. Is that something that everyone is seeing? Because I don't want to get into the business if I keep adjusting the slides. Meanwhile, the remainder of the class is saying, no, I see it fine. And I'm,
No, you're blocking part of your written stuff on the slide.
I'm not blocking anything, but let me come out and, yeah, the answer to the question is no. I don't think. Let me try this. Okay, now you can see it better?
Yes.
Okay. Okay. Question? Okay, good. Now, another thing that we want to talk about here is interest expense. And I think I can put it back in slideshow mode. Okay, good. Now, what happens? Let's say I borrow money. Okay, when you borrow money, what are you buying when you borrow money? You see a nice, beautiful car you want. You feel like, man, I gotta have this car. What are you borrowing when you borrow the money for that car? What are you buying when you borrow the money for that car?
Personal expense.
I don't know what that means. What are you borrowing? What are you, huh?
Credit?
What are you buying when you borrow that money? There's no personal expenses here. Everything we're doing in here is business. There's no personal stuff.
You're paying the car off with what you borrow, right?
Well, let me give a more specific example. You buy a car for $50,000. You don't have 50,000. So you tell the guy, sorry, I can't buy the car. I don't have 50,000 cash. The guy says, no problem. Sign here. You can have the car.
You're buying debt.
No.
A loan?
That's a loan, but what are you getting by taking it?
The money needed to buy the car.
Okay. And
Liability,
then you give the money away and you have the car. So what have you gained?
An asset.
Okay, you got an asset out of the deal.
Credit?
You
A
got
liability.
but if you had cash, you could have that asset too. So what is the borrowing doing for you?
The liability.
Okay, it's giving you a liability, so you're happy. What's making you happy?
You got a nice car.
You got a nice car and you have it when?
right now.
You have it now. Good. You have it now instead of what?
Later.
Later. So what have you just bought? I know you bought a car, but if you had cash, you could have bought the car too. What have you really bought by the borrowing?
You
What is-
bought, you
bought
borrowed,
time.
you bought the
Yeah.
time that you needed to
Thank you.
get the car.
Bought time. When you borrow money, what you have bought with that borrowing is time. Now, the cost of that time is going to be what? Interest. You're going to have to, at least in the United States, you're going to have to pay interest on that because it gave you time, didn't it? You got it now instead of having to wait. Okay. So when we recognize, and where I was going with that is when you recognize interest expense, you're recognizing what? The expiration of time, because as time goes on, that future economic benefit that you got from the borrowing does what? Expires, and now you have to take the interest expense. Okay. So when we calculate interest expense, we calculate that as time passes. Okay. Now, I keep talking about bringing the calculator to class, and I don't think anybody does that because I know in my live classes, when I ask the class to pull out their calculators, everybody sits there and looks at me like I just asked them to fly around in circles and above the ceiling, you know. The way you do this is you put in your calculator 5,000. That's the money that was being borrowed here on October 1st, and we want to calculate the interest. To get the interest, you go ahead and you multiply that. In this example, since it's 12%, you take 12% per year, an annual rate. Interest rates are always called out in terms of an annual rate. Okay, so you take that 5,000 times 0.12, you hit equals, that's showing me 600. But that would be for what? For the entire year. Okay, so then I have to go ahead and divide. And since we're only talking about what? 1 month here in this example, the way they set up this slide originally, they were asking for it at October 31st. So that's 1 month. You divide by 12. That means I'm incurring interest expense of $50 per month as each month goes by, as time passes, the future economic benefit of having borrowed that money expires. Okay, so I would debit interest expense for $50 and credit interest payable for $50. I go ahead and I post the interest payable. I post the interest expense for $50 at 10/31, right? Now, I would again repeat that on November 30th and on December 31st. I go ahead and I post those. So now I'm up to 150, and my interest expense is what? 150, because now what? Now 3 months have gone by, October, November, December.
Yes.
Okay. Okay, good. Now, let me ask you a question. When I borrowed the money, forget the car example. Let's say I was just borrowing the cash straight out. When I borrow the money, how much cash am I getting when I borrow that money? How much cash am I getting when I borrow?
5,000.
Good. So I'm going to debit cash. 5,000. Good. What am I crediting? I'm assuming, well, I'm going to go ahead and call it a note payable. Okay, when you start to get into this kind of thing where there's interest, etc., it is typically a note. A note, beyond the core scope of this class, has a very specific definition. It has an amount. It has to state that it's a time certain to occur as to when I'll have to pay you back. And so it can't say, I'll pay you back when the Raiders win the Super Bowl. Okay, that's not a time that's going to happen. It has to be a time that you're able to calculate or anticipate. It can't be, I'll pay you when I die, because somebody said, well, we know you're going to die, but we can't say when that's going to be. So no. So it has to have certain requirements to be considered a note. Okay, so it's not an account payable, it's a note payable that I would go ahead and credit for 5,000. Now, if I go ahead and I post my note payable over here for 50,000, not 50,000, but 5,000. Okay, now I got a balance of 5,000 sitting there, right? Okay, good. Now, let's say I went ahead and I made these journal entries on October 31st, the 30th, the 31st. January 1st comes, and the guy that loaned me the money, his name's Bruno, comes knocking at the door early in the morning on January 1st and says, you owe me my money. Where's my money? How much money am I going to have to give him?
Wouldn't it be 150 after the 3 months?
Okay, you say I want to give him 150 for the 3 months. So Bruno's driving home and he gets halfway home and he says, wait a minute. Why is he not happy?
Because that's interest. That's not the actual payment. So you add it to the actual payment of 3 months.
Good. I got to give him what? 5,000.
5,000 plus
Money back,
150.
right. Good. So at that point in time, excellent. So at that point in time, where do I want to write this? He would go ahead, I would have to go ahead. I'm going to erase this now, guys. I don't need this anymore. I'm running out of room here. So at that point, I would go ahead and do what? I would credit cash for how much? How much?
5,000.
Huh?
5,000.
5,150.
Good. 5,150 because I got to pay him the interest too. Okay, good. Now I can debit what?
Note payable,
Note payable for
5,000.
5,000. Can I debit it? I have to debit. I know I have to debit something else for 150. What do you want me to debit for 150?
Interest,
Interest what?
payable,
Good. Interest payable. Gonna get debited for 150. That zeroes that out, doesn't it?
yes.
Look at him now. And Bruno's happy, I'm happy.
Yes.
Yes, I'm happy. Anytime you gotta hand somebody a check for 5 grand, you're not that happy. I don't care what the situation was, even if you borrowed the money and spent it and enjoyed it. Nobody wants to pay a bill when the time comes, but whatever. Okay, now, one more thing about any question on that? Okay, one more thing on this now, which is what I did right here. Over here, you may get a question. We'll look at one of the practice midterm here in a little while. You may get a question in which they say, well, the company didn't accrue any monthly interest. They waited until December 31st before they recorded any interest. What would be the adjusting entry at December 31st? Now you could sit there and figure it out a month at a time. But the way I do these is I take my calculator, the thing that God created for this class. I take the 5,000, I multiply it again by 0.12, I hit equals. That gives me the 600. I then multiply that by 3 and I hit equals. That gives me 1,800. I then divide that by 12 and that gives me $150, the amount of interest for the 3 months. The reason I ask you to do it that way, guys, is these calculations can get tricky and every calculator has its idea as to the order of operations and what they want to do to you with that. And the safest way to do it is to put in whatever the principal amount is, okay, the face of the note, times the interest rate, always stated annually. That gives you the interest for the whole period. It equals, multiply that by the number of months you're trying to figure it out for, and then divide that by 12, and that will give you the correct answer. Okay. Okay. I know we have a couple more slides left. I am not going to ask you questions about the classified balance sheet on your exam. Okay. We will get to this after our midterm because I'm getting a little concerned that we won't have enough time to go through and finish or get a good chunk of that chapter 3 practice midterm. And I want to make sure that on Thursday, we have another round of practice midterm for that one that I showed you. So I'm going to stop there on the slides. Okay. We don't need to get into this right now. We'll get into all this a little bit later. Okay. Because that might take us a while and I don't feel like doing that right now. And I won't ask you anything about classified balance sheets, so ignore those last few slides. And what we're going to do when we come back after the break, okay, is start to take a look at the chapter 3 practice midterm, which apparently my computer is a genius at closing things that I want open. So I will have to find that again, apparently, and we'll get started on that. So let's make it, let's see. Sort by type. Okay, good. So we will start that at, and we will start it here in 10 minutes at 10:46, and let's see how much progress we can make with this, okay? Okay, guys, I'll see you in a few minutes. I'm gonna pause the recording. Somebody please remind me to start it up again when we come back. Go ahead and resume the recording. And let's go ahead and start to take a look at the chapter 3 practice midterm, see how far we can get through this. If we don't finish it today, again on Thursday we'll finish it, and then we will look at least one of the more comprehensive practice midterms that I've shown you earlier on campus. Any question before we get started? Okay, so when you look at this problem, they say the balance in the supplies account on June 1st was 5,200. Okay, so what I did was I just went ahead and set up a ledger account for this, sort of showing us, okay, the problem started us here, that there was 5,200 in the supplies account. Okay. Then it tells us that the supplies purchased during June were an additional 3,500. So they went ahead and purchased some more supplies. At that point in time, I went ahead and I assumed that they bought the supplies for cash. Doesn't have to be, and it's not relevant to this question. I just assumed they bought them for cash. So we go ahead and we debit these supplies. And when we post that, the account balance goes up to 8,700, right? Then they say that they went and they counted the supplies, and the supplies on hand by the end of the year were what? By the end of the month, by June 30th, were 3,000. In other words, they're sitting there and they want this account balance to show 3,000 because that's what's still on hand. That's what we still have future economic benefit for. So they say, what would be the amount for the appropriate adjusting journal entry? And as I was saying last time, when you see a question like that, your job is not to sit there and kind of think in your head, what would be the amount? Make the adjusting journal entry and then compare it to the answers. So how do you turn an account balance, an asset that's showing what? Showing 8,700, how do you turn it into so that it shows 3,000? That's a question.
You credit it?
Good. You have to credit that account for what? $5,700. Okay. And then we have to debit something, of course, and we would debit what? Supply expense, because when we counted up the supplies, there was 5,700 that wasn't there anymore. Any future economic benefit associated with that has expired. That's the full journal entry, and then that led you to the answer here at 5,700. Again, as you know, on your exam, your the answers will not be highlighted, right? So the best way to get through these is to sit here and to go through this process, make the journal entry, compare it to the choices. Question. Okay, good. Let's go ahead and let's take a look at this next one. And I think, by the way, guys, the names that they're using for the companies are rock bands from the 80s or something. So I didn't make these names up. So if there's some stupid name in here that you don't like, it's came with the textbook. Somebody got cute and named all these companies after rock bands. Okay, so what happens? REM Real Estate received a check for $27,000 on July 1st, which represents 6 months advance payment for rent on a building that it's renting to a client. Now, when we receive that cash, does your cash go up when you receive cash?
Yes.
Yes.
So you have to debit the cash. you can't credit revenue because time hasn't passed. The future economic benefit associated with somebody paying their rent in advance is the rent in the future. And I haven't earned that yet. So I have to do what? Credit unearned rental revenue, whatever. Okay. When I post that, the account is at that point showing 27,000, right? Don't worry about this other thing. I'll show you here in a minute. But right at that point, it's showing 27,000 is the balance. Okay. Now, what happens? The question says, well, what should they do at July 31st? Well, July 31st, 1 month has expired, hasn't it? Okay, so if I've got $27,000 of rent, it's over a 6-month period, the question told me. That means that what? I'll earn $4,500 a month as time passes on that rental agreement. So at July 31st, I don't know, did I say December 31st somewhere in there? I didn't mean to. At July 31st, now I can debit the unearned revenue. Okay, you see the answer up there. Debit the unearned revenue for $4,500, credit rent revenue for $4,500. Okay, now when I go and I debit that unearned revenue account, now it's showing 22,500 is what's left, which hasn't been earned. And just for sort of, enforcing our understanding here, I went ahead and said, okay, yeah, that's right. 22,500. I've got 5 months left. That ties to the $4,500 per month, right? Question. Okay, let's look at question 4 and then we'll come back to question 3. Okay, so question 4 right here. Okay, if you have a question, guys, stop me. Okay, I'll ask question, but if I go too fast in the next question, just say I had a question about the last one, whatever. Okay, so what happened? We're sitting here and they say, what is the proper adjusting entry June 30th at the end of the fiscal year on a prepaid insurance account balance before adjustment of 18.5 and unexpired amounts per analysis of the policy of 6,000. Okay, now when we bought the insurance, and I'm kind of co-opting this space down here for number 4. When we bought the insurance, we debited the prepaid insurance, right? Credited the cash for 18.5. And so when we debit the prepaid over here was showing a balance of 18.5, right? With me so far? Okay. Now the question doesn't make me do any math. It tells me that what? That 6,000 still has not expired. Well, if it's 6,000 that has not expired, then I want to turn that account balance from 18.5 down to 6,000. Okay, that's the unexpired amount. So I go ahead, and if I want to turn an asset account that's showing a balance of 18.5 into 6,000, what do I do to it?
Can you repeat that? Sorry.
Huh?
Can you repeat the what you said?
Yeah, if I have an asset account, prepaid insurance, that I want to turn from a balance of 18.5 to 6,000, because the problem told me only 6,000 hasn't expired. What should I do?
Would you
Credit.
subtract 18.5 and the 6,000 from 18.5 to get the difference?
Speak to me in accounting, please. If I have an
Credit.
asset account that's showing a balance of 18.5, how do I make it show 6,000?
Credit it.
Huh?
Credit it.
Good. I credit it for what? For 12.5, don't I?
Yes.
So I look at this and I have to credit the prepaid insurance for 12.5, and if there's only 6,000 unexpired, that means that what? 12,500 has expired.
Yes.
Yeah.
Good. Okay. Okay, good. Now I said I'd go back up to 3 if there's no question on that one. And it says, as prepaid expenses expire with the passage of time, the correct adjusting entry is to do what? as it expires, debit expense, credit the asset account to bring it down to show that some amount is expired, right? Choice B.
Yeah.
Okay. Okay. I think you see, guys, why it sounds like I'm being an ass when I keep holding you to the language, but that's how we're going to test you. I mean, this is the way accountants speak, and this is the way the questions are going to be presented to you. So you have to use the correct terminology and get used to that, so that when you're looking at the question, it's speaking to you what it is that they want you to do, as opposed to what, I don't know what all these words mean. Okay. Okay, good. Number 5. And again, they've named these after music bands from the 80s here, I guess. This NWA Air Charter signed a 4-month note payable in the amount of $20,000 on September 1st. The note requires interest at an annual rate of 9%. The amount of interest to be accrued at the end of September, it's September 30th, is what? And I went ahead and I wrote in the calculation here, in which I said, okay, the 20,000, that's the principal, right? Times the 9% interest rate equals what? 1,800. And I say multiply that by 1/12. Since it's 1 month, that's multiplying by 1/12 is equivalent to dividing by 12. And when you divide by 12, you get what? You get $150. And I thought I had written in the journal entry for that, but I guess I didn't. So let's go ahead and write it in. I'm going to debit what? Interest expense for $150. What should I credit?
An expense.
I already debited the expense. I'm not going to credit and debit an expense in the same journal.
Credit the
You're gonna
note
credit
payable.
assets.
Why would I credit assets? And furthermore, what journal entry involves crediting an account called assets? That's 2 questions. Why would I credit an asset account? What am I going to credit?
Would you credit the note payable?
Well, you're on the right track.
Okay,
Is the note part that's payable? I mean, when I got the money, I debited cash
oh, that's
for
right.
50,000 and I credited note payable, not, what is it? 20,000. And I debited note payable for 20,000, right? Is this part of the note or is this something else? I debited interest expense because time has passed. How much do I owe this person now?
The amount of the note plus the interest,
Okay, so is
the,
it the note part that's increasing, or is it the interest part that's increasing?
The interest.
the interest,
So what do you want me to credit?
the interest expense.
I already debited interest expense. Why would I credit it?
Interest payable.
This is-
Payable, I'm sorry.
Debit and credit the same account. Go ahead. Go ahead. What would I credit?
Interest payable.
Good. I'm going to credit interest payable for $150 because now I owe that interest, right? Okay, good. So no, I don't credit an asset account. I credit a payable because time has passed, and if I could presumably, depending on the terms of the note, but let's say there was no prepayment penalty or anything on that, I could go to the dude and say, hey, you know what? I'm done. Here's your 20,000. Here's the 150 interest that I owe you for the 1 month, and I'm done with this, right? Okay. Okay, good. Let's try another interest one because I know that we just had kind of looked at that a couple minutes ago. So now we're getting stronger at that. Let's look at another one. Uncle Tupelo signed a 3-month note payable to help finance and increase inventory for Christmas, whatever. The note is signed on November 1st in the amount of $75,000 with annual interest of 12%. What should we do on December 31st to calculate the interest expense? Okay. And so we go ahead and we have to, and let's just first kind of review what's happened here. This Uncle Tupelo, whatever, borrowed 75,000. If you borrow 75,000, does your cash go up?
Yes,
Okay, so I'm going to debit cash, 75,000. I have to credit something. What should I credit? What should I credit?
Note payable.
Okay, good, excellent. Okay, so I owe this person 75,000 now, right? My note payable will show that I owe 75,000 on this. Okay, now they tell me that I signed the note November 1st, and they say I hadn't made any entries in November, apparently. So what should I do at December 31st? Well, how many months have gone by?
2.
2, all of November, all of December, 2 months have gone by. Good. So I do what? I take that 75,000, excuse me, times what? 0.12. That equals 9,000, but that's for what? The entire year. So I take 9,000 times 2. That would give me 18,000. I divide that then by 12. That gives me what? $1,500 of interest that is accrued for those 2 months. I debit interest expense, $1,500. I credit not note payable, but what? Interest payable for the $1,200. I mean, excuse me, $1,500. Question. Okay, good. Let's go ahead and let's take a look at this one. And this is very similar to another one we've already seen. Okay, what is the proper adjusting journal entry at June 30th at the end of the fiscal year based on prepaid insurance account balance before adjustment of 15.5? So I'm showing you that the prepaid insurance had 15.5 and the unexpired amount is what? 6,000. How do I turn an asset account from a balance of 15.5, decrease it down to 6,000?
Credit it.
Credit.
Good. I know I've got to credit the insurance. Excellent. You guys are getting there. I have to credit the prepaid insurance for 15.5. Okay. I mean, excuse me, for 9.5. And then I have to what? Debit the insurance expense because the what? Future economic benefit on that insurance policy has expired. Now, this number 9 is similar to some of the others that we've looked at, but it's got a little wrinkle in there. And that this problem starts me out for this Murmur company that they've already taken for the year 1,450 of insurance expense. So they kind of start us there. You already have 1,450 in insurance expense. And then they say that you had his prepaid insurance account and its prepaid insurance account had a balance of 38. So they kind of start us there. They're saying insurance expense so far as this, you have prepaid of 38. Apparently they must have done what? They must have at some point debited the prepaid insurance for 3,800 and credited cash for 3,800. Apparently that happened in order to get that. In fact, now I can just go ahead and post it. That's how that balance got up to 38. Now they sit there and they say it was determined that 2,800 of the prepaid insurance had expired. If something expires, what am I supposed to do?
Credit.
Credit what?
Expense.
the expense account.
Why would I credit an expense account if something has expired?
Because it has no future economic value.
Okay, if the future economic benefit has gone down, don't I want to increase the expense account?
So you debit it.
Okay, so I debit insurance expense 2,800. Right? Hello?
Correct.
Yeah.
And as it expires, I credit the prepaid. That brings the balance down to the 1,000, which is what the balance would be. The question, this question didn't ask me that. Hang on, we'll look at the next one, but that would bring the balance down to 1,000. So if I started with 14,500 and 2,800 has expired, 2,800 more has expired, that means I need to bring that to 40. That'll bring that to 40,250, right? The answer. Hello?
Yes.
Right? Everybody?
Yes.
Yeah.
Yes.
Okay. Okay, good. And then I just kind of threw in this question here, wasn't part of the textbook's teaching of this, but I said, well, what's the ending balance in the prepaid account? It's 1,000, isn't it?
Yeah.
Yes.
Okay, good. Let's take a look at a couple more. Let's take a look at one more. And then what I'm going to do is ask you to, we're going to look at this last one. It's not the last one in the file, but this question, we're going to look at this. I'm going to turn you loose on the rest of them. We will review them together on Thursday. We'll do at least one of the practice midterms, depending on time, on Thursday. And then the exam's going to open, and you're going to have until Monday, the 13th at 11:59 p.m. at night to complete the 30 multiple choice questions that'll be contained in that exam, right? Okay, so let's look at this one. They tell me that the balance in the prepaid rent account before adjustment is 18,000. So apparently they're saying that was on December 1st. Someone must have handed me cash of 18,000, and I went ahead and I credited the cash. I debited the prepaid 18,000, and so the balance before any adjustment was what? 18,000. Okay, and they tell me that this represents 3 months prepaid rent. So 18,000 divided by 3 means that what? I'm going to earn 6,000 a month on this deal, right? Okay, so they want to know, well, what should I do at December 31st? Well, that's what? That's 1 month. And so December 31st, I can go ahead and, oh, okay. Sorry, guys, I started doing the unearned. And it's actually what? It's actually prepaid rent.
Yes.
Okay, so I was doing it for the unearned, but it's what? It's prepaid rent. Okay, so prepaid rent means I have an asset, right? I paid that in advance for the 3 months. So I debit the prepaid rent and I credit the cash. The prepaid goes up to the 18,000. Okay, now what's going to happen? 6,000 a month is going to expire. So at December 31st, now 1 month has expired. And so I would go ahead and debit the rent expense for the amount that's expired to 6,000. Credit the prepaid. When I credit the prepaid, it's showing what? 12,000 is left. That's covering me for what? The next 2 months, presumably January and February in this example, which will expire next year. Question. Okay, guys, I think that's enough for today. Continue to look at these other questions. We will pick this up here on Thursday, and then we will look at the practice midterm together, okay? Okay, guys, I will see you on Thursday. Keep up the good work, all right? keep working hard. I think we're
Professor,
getting,
I have a question.
yeah.
What's the passing, how many questions can we miss on this midterm in order to pass it?
When I get a question like that, I get a little nervous because it makes it sound like we're planning to not get an A.
Oh, no, no, no. I'm planning to get an A. It's just, I like to know all my options just in case something happens, I get nervous or I just fumble.
Okay, well, I just don't dabble in that part of life.
Ah,
For me, I'm like, on the day of the exam, I'm gonna nail all of this, okay? But since you're asking, and I feel like I want to answer, I guess, then the way you would do that is you would look at the syllabus for the class, okay? And maybe this helps for other classes, not mine. Okay, and you would look at the syllabus and you would say, well, there's 100 points on the exam, and the exam constitutes 60% of my grade. Well, maybe that's not where you start. You look over here, and if you're planning to get a C on the class, then that would mean at a minimum you must get 73% on of the points on any one assignment, right? On average.
yeah.
So if you take 73% of 100, that would, well, you're trying to get 73% of 100, yeah, would be 73 points. So 73 points, and then if the exam has 100 points and there's 30 questions, that's 3.33 points per question. So if I divide 73 by 3.33, that means I need to get 21.92 of the questions correct to get a C. So that means that I would be able to miss 8 questions. I don't know how that helps you. I don't know how that
Makes me want to
analysis
study more and
helps you.
more.
Huh?
It makes me want to study more and more.
Okay.
Well, thank you.
Don't go there. I mean, that's kind of like an army going in and saying, how many guys have to get killed in order for me to not quite win the war? I mean,
But I
we're,
appreciate you explaining.
we're up here. I don't see any reason to not say, man, you should be walking around to your, colleagues at the ends and saying, dude, I'm getting an A in the accounting class. Come on now. This stuff is easy.
Yeah,
Okay.
it is. Thank you very much. I really appreciate it.
Okay, guys.
Have a good day.
All right.
Thank
See
you.
y'all.
See you next class.
Bye.
Thank you.
Bye-bye.